Now, Nolan, you've told us that as interest rates go up, bond values go down, and when you take the bite of inflation out, that 4% bond, well, it's now paying you 2%. And Jeremy Siegel at the Wharton School of Business tells CNBC, 2%, it's not going to get it done.
2% a year, it's good. It's the biggest in decades. However, 2% after inflation a year takes 36 years to double your money. You double your money in bonds, you've multiplied your money by 5 times in stocks. So people who tell me, oh my goodness, bonds are as good as stocks, no way for long run wealth creation.
So if bonds aren't getting it done, I have to wonder, what are the alternatives?
Well, I think, it's nice to see that bond prices or bond yields have come up over the last year with rates going up. But I recently had a conversation and met with a client, and I looked at their 401k. They had like a 70-30 mix, meaning 70% equities, 30% bond funds. Mm-hmm. But when we looked at their bond fund, and if you go out and you look at like the aggregate bond index, although yields are up, the price of bond funds are still down here as of the recording here in October of 2023. Year to date are still negative. So an investor in that case is still losing money on bond funds. In fact, when I looked at the case of 10 years, bond funds have been very minimal. In fact, the aggregate bond index, I think the yield over 10 years is about 1%. So the question becomes, what are we going to see going forward? If we looked at the environment of the 60s and 70s where we had, a high regulation, we had poor government spending, we had, geopolitical uncertainty, kind of a lot like the environment that we lived in today. We had this problem that lasted for a long time. So if we think about it and we look at, what are the alternatives to bonds, and if not bonds, what else? I do believe that we're in an environment where people can take advantage of some things that are out there. First of all, I'm a big fan of the money market accounts that are out there for short-term money. Money market funds accounts are significantly higher. I've seen money market funds in the 5.5% range right now. I'm a big fan of FDIC-insured bank CDs. Again, bank CD rates right now, short term, meaning that 1 to 2 year time frame, are fairly attractive in that 5 to 5.5% range as well. It's an interesting environment though because you have an inverted yield curve. So the longer you go out, and lock in things like an FDIC insured CD, the rates actually can be lower if you use a website like bankrate.com. So the other alternative is to look at things like fixed annuities. With a fixed annuity, I think this is an interesting time in the environment where you can lock in a rate longer, 3, 5, or 10 years, and you can get a rate that is significantly higher than what you could get in other traditional investments. And when you're looking at these other products, what you're doing is you're taking the interest rate risk out of the portfolio and buying something that's not subject to the volatility of the stock and bond market. So when I ran the analysis by doing that with that 70-30 portfolio, I think it reduced the risk to the end investor by about 20% and provided more consistency in the portfolio. And so the last category would be index annuities, which allows people to participate when the market goes up, but protects them when the market goes down. So again, if you have a target date fund, and specifically if you're over 59 and a half, let's talk about what alternatives there are to bond funds, specifically in your 401k.
Because, again, it's going to matter from person to person. This is obviously general advice, but you really want to get down to the details as it pertains to your retirement, and that is something the team at America's Retirement Headquarters will be happy to do. To get started, just give a call, 419-794-3030. You can always visit them as well online at arhq.com.